You know, a banking crisis, it can feel like something that happens somewhere else, right? Just a headline. But in 2017, for millions of people in Ghana, it became a deeply personal catastrophe. Today, we're going to unpack the tough lessons learned from that crisis to help you build a solid, crisis-proof plan for your own money, no matter where you are. And just to give you an idea of the scale here, we're not talking about one or two banks having a bad day. We are talking about over 400 microfinance institutions, on top of 9 major commercial banks that completely collapsed. The dominoes fell, and boy, did they fall fast. And that's the thing, right? Behind every one of those numbers is a person, a family, an entrepreneur, someone saving for retirement. Millions of people who woke up one day to find their life savings were suddenly trapped, or even worse, just gone. This wasn't just a financial headline. It was a disaster for real people. All right, so here's how we're going to break this down. First, we'll look at the shock to the system. Then we'll walk through 3 absolutely essential lessons: how to diversify, how to vet your investments, and how to monitor your bank. And we'll wrap it all up with a concrete action plan you can use to protect yourself. Okay, let's jump right into the first and most fundamental rule of financial self-defense: diversification. You've probably heard this a million times before, but this crisis really showed why it's so critical, even for the cash you think is totally safe in the bank. So check this out. This is where it gets really scary. Deposit insurance is great, but it has a limit. In Ghana's case, it was 100,000 cedis. So if you had more than that in one bank account and that bank went under, everything above that limit, poof, gone. Absolutely no protection. So what's the move? It's actually super simple. First, do not put all your trust in one bank. Get an account at a second licensed bank. And second, pay close attention to that insurance limit. Try to keep your balance in any single bank below that number. That way you know every single dollar or CD is covered. And really, this is just applying a classic investing rule to your everyday cash. I mean, you'd never put your entire life savings into one single stock, right? The exact same logic applies here. Just think of different banks as different assets in your cash portfolio. All right, on to lesson number 2. This one is all about asking the tough questions and really understanding what's going on behind the curtain. It's not enough to know your money's at the bank. You need to know what the bank is doing with your money. This is the trap that so many people fell into, and it's a sneaky one. They thought they were putting their money into a safe, boring, fixed deposit. But behind the scenes, some of these banks were taking that money and lending it out to really risky companies. So when those risky ventures failed, the depositors' money vanished right along with them. Now, just look at this gap. It tells the whole story. These struggling banks were offering these incredible, too-good-to-be-true interest rates, like 22%. At the same time, the super safe government treasury bill was paying around 14%. That extra 8%, that wasn't free money. That was danger money. It was a giant red flag that they were taking huge risks. Okay, so how do you avoid this? Simple. You've got to be direct. Ask them point blank. What is my money actually being used for? Then, do a quick reality check. Compare the rate they're offering you to the government's T-bill rate. If it's more than, say, 2 or 3% higher, your alarm bells should be screaming. And honestly, this is probably the most important takeaway here. If the person trying to sell you a financial product can't explain it to you in simple, clear terms, just walk away. It's your money. You should never, ever just hand over blind trust. All right, lesson number 3. This is where we shift from just being a passive saver to an active watchdog for our own money. And don't worry, this isn't about becoming a financial analyst. It's about building a simple habit that takes maybe 15 minutes every few months. You know, looking back, the clues were all there, right in plain sight. People started noticing these crazy long lines at the banks. They had to deal with constant delays just to get their own cash out. And they could literally see the stress on the faces of the staff. These weren't just signs of bad customer service. They were symptoms of a much bigger problem. So here's your homework. It's like a 15-minute financial health checkup. Once a quarter, just hop on your central bank's website and make sure your bank is still on the list of healthy, solvent institutions. And if you're feeling ambitious, take a peek at their financials. Are they making money? And here's a big one. Are there non-performing loans, basically bad loans, below 10%? Okay, let's bring this all home. We've gone through the lessons. Now let's build your action plan. This is all about shifting your mindset from just reacting to a crisis to actually building a financial setup that has control and resilience baked right in from the start. And this
This might be the biggest game changer of them all. Because even if you do everything right, a major system-wide crisis could still freeze everything up. The ultimate line of defense is having a financial buffer that doesn't depend on the banking system at all.
And I absolutely love this idea. It's called the Waakye Emergency Fund. Now, Waakye is a really popular and affordable street food in Ghana. The concept is simple. You should have enough easily accessible cash, either physical cash stashed away or in a mobile money account, to cover the absolute basics like food, water, and transport for a few weeks, even if every ATM in the country suddenly goes dark. So here it is, the whole game plan on one slide. Think of this as your personal crisis-proofing cheat sheet. For every lesson, you've got the core action you need to take and the specific red flag you need to watch out for. It's all right here, from spreading your money around to keeping that external buffer. You know, we spend so much time worrying about market risk, the stock market going up and down, but this crisis is a huge reminder that there's also institutional risk, the risk that the very place you keep your safe money might not be safe after all. But the great news is that protecting yourself isn't about some complicated financial wizardry. It's about building simple, powerful habits. So I'll leave you with this one final thought. Your bank probably looks perfectly fine today. The lines are short, the staff are friendly, but now you know what to look for. So ask yourself, honestly, is my money truly set up to withstand a storm? Is it really crisis-proof?